So with that, just a quick agenda for today. We're going to start with why the due diligence process matters and what the process is all about. And then we're going to get into the nuts and bolts of what due diligence is, what you should really be looking at as a buyer for a potential business. And then the last question there should actually say questions, but we will talk a little bit about the deal cycle and timing and the question period and when and how to do due diligence. So if we start with why, let's talk about how mergers and acquisitions in the grand scheme are getting a bit of a bad name. So KPMG did a study that indicated 83% of mergers did not boost shareholder returns. About 50% of mergers are actually reversed within 10 years. And then 23% of employees, after there's been a change event, are actually actively disengaged. So none of these stats are really a strong endorsement for pursuing M&A activity. And how are you going to handle that as a potential buyer? So one of the reasons that I think that this is happening is that deals have a certain appeal to them. They can seem exciting. You know, there's a big press release at the end. Everyone's like, ooh, did you see, so-and-so bought this company. But sometimes it's forgotten that there's a lot of proper process that actually goes into a successful deal. And so really what we want to do today is help arm you with what that process looks like to make sure that you can have a successful deal when the transaction comes. One of the things I wanted to do is talk specifically about the Canadian lower middle market, which is the part of the transactions landscape that most of you as buyers would be looking to operate in. And so the Business Development Bank of Canada, or the BDC, did a study that indicated 41% of Canadian entrepreneurs plan to exit in the next 5 years. And of that, 52% of them expect to sell or transfer their business outside of the family. So there's going to be lots of inventory of businesses coming for sale. But if you drill down on that study and look at some of the facts out of it, there's a few different trends that are interesting. 40% of those same business owners who said they want to sell their business actually haven't done anything to begin to plan for that transition. 63% of those owners haven't done anything to maximize their profits in advance of that sale. And then over half of them, 51% of them, aren't even considered to have sound financial reporting. And so as Pierre Cloureau, who is the chief economist of the BDC, points out, Canadian business owners are leaving their money on their table by not properly preparing for the process. But as buyer, this actually creates an opportunity to buy these companies at a bit of a discount and get the value out of them post-sale. But it also creates a bit of a warning that if they don't have sound financial reporting, how are you going to get your head around buying that company and making sure that that valuation is accurate? So that brings us into due diligence 101. So why even do due diligence? Why do we care? So really, at the end of the day, due diligence is what enables you to capitalize on deals opportunities ahead of you. It ensures that there's transactions readiness. We've sometimes been engaged by buyers because management of the seller only has so much time, and they're maybe talking to 10, 15 potential different buyers. So how are you going to stand out? How are you going to look like you're taking this process seriously? So there's been times where we've actually been contacted by buyers because the broker won't let you talk to management unless you've actually hired that representation that shows you're serious. So sometimes it's just bringing that independent advice to the table to make sure that a good deal can get done, and the seller wants to make sure that happens too. So I like the quote, if you quit on the process, you are quitting on the result. So what exactly is financial due diligence? And I like to describe it as the middle of the Venn diagram where deals expertise meets technical accounting. And so by that, I mean, if you look at a financial model or valuation, most of the inputs are accounting driven. They come off the face of the financial statements, and accounting really drives how that number was created. So like anything else, garbage in, garbage out. If we don't really understand how that number was estimated, the different accounting policy choices available to management, and then we take that number and it escalate it, 5% over 5 years, that number is not going to be overly meaningful. But on the other side of that, just like anything else, context matters. So a number could be correct from a financial reporting or a taxation standpoint, but that doesn't mean it's correct in the context of a deal. And so a financial due diligence professional really needs to be able to speak both sides of that language and understand both to do a proper engagement. One of the analogies I really like in explaining financial due diligence is it's really the home inspection of a business. So if you think about this from a real estate context, if a seller is hoping to sell their house, they'll probably hire a real estate broker. They'll expect them to come and take a bunch of nice pictures, create marketing materials, and otherwise market their business. Maybe they're holding open houses and generating a buzz and basically brokering that transaction on their behalf. And that broker's paid a success fee or commission based on that deal closing. On the other hand, as a buyer, you'll probably put in an offer to buy that house subject to the condition of it passing the home inspection. And that's where you just want someone who isn't tied to the outcome, who's just going to go in, check the house, and make sure everything's good to go, and it's a strong foundation before you close that major investment. Same idea with financial due diligence, and that's why we're a fixed fee compensation. As you can imagine, if you said to a home inspector, you know what, I'm only paying you if I buy this house, but please go tell me what's wrong with it, it just doesn't work very well in practice. So what are we talking about when we talk about a purchase price, and how do you make sure that you're valuing a company properly if you're looking at buying it? And so this comes down to the idea of the purchase price equation. So really, if you boil due diligence down to its fundamental level, it's looking at each component of this purchase price equation to make sure that you're having the proper valuation and impact to get to the correct purchase price. One of the things that I also wanted to mention is the idea of quality of financial information. And so often a section of a due diligence report speaks to, did they have reviewed or audited financial statements? When we were looking at things like, say, their customer concentration, if we got a report out of their system that had sales by customer, did that total number of sales actually tie back to what they had on their financial statements? And every time that something's a bit disorganized or messy, or we're doing this transaction in June, but we can't get any information since December, so maybe the financial reporting process is slow. Those are all indications around, how much faith am I actually putting in these numbers, and how comfortable am I buying this business? So if we look at business valuations 101, there's generally 3 different approaches to value a business. There's the income approach, the market approach, and the asset approach. And so the income approach, generally speaking, is used most commonly for small to middle-sized businesses. And it's picking an income-based multiple. This could be revenue, but most of the time that's adjusted EBITDA, timesing it by a multiple, and that gets you to the total value of the business. The other way of looking at it is from a market approach. So if we're going to carry on the home buying analogy, you could look at what other homes similar to your house sold for in that area. You could look at other houses that are currently on the market, and that could help you understand what the value should be. And so that's known as precedent transactions or comparables, and looking at those types of multiples. And then the third way is really kind of considered a floor approach, or the bottom valuation, which is really just looking at the assets. Normally businesses that we're looking at buying are a going concern, they are making money, so there's a goodwill component that gets you from that floor asset value approach up into the income approach. So EBITDA is thrown around a lot, but what does that actually mean? And so EBITDA is an acronym for earnings before interest, taxes, depreciation, and amortization, which really doesn't mean a lot to most of us unless we actually kind of look at what that actually does and what that means. And so when you look at a profit and loss statement, by the time you get all the way down to net income, there's a bunch of different noise in there. There's non-cash items, there's things that were subject to management choice of their accounting policy, their tax strategies, whether they wanted to capitalize or expense a certain purchase, all those types of items. And really, as a buyer, I might choose to do those things completely differently. I might choose to have a different capital structure and use more debt versus equity. So how do I get to the actual true operational earnings of this business that are going to be what the business is doing post-close? And so that's what EBITDA does, is it adds back all those kind of non-cash accounting policy, tax, those types of items. So I can just get down into the heart of what this business is actually doing operationally. The multiple is generally a reflection of risk. And so it's the idea of, if you put yourself in the seller's shoes, they're probably not going to sell their business to you for just 1 year's worth of earnings. You're buying that business in perpetuity. So how many years of earnings do I really feel comfortable paying on? And it's generally a reflection of risk and also just what quality that business has. If you're actually building up the multiple as opposed to looking at precedents and comparable transactions, you can look at their equity cost of capital. And so that's a buildup of the different factors that impact that particular company's risk. And then if you take 100% divided by that risk, that is actually how you derive a multiple. So what do we mean normal? And when you say adjusted EBITDA, normalized EBITDA, what does that actually mean? And so the thing to remember is that if we're going to take an earnings metric such as EBITDA and apply a multiple to it, the multiple is really representative of the fact that this should be what's happening year over year over year. And if it's not, then why would we give them a credit for that in terms of adding a multiplier to it? It's got to be what we think this business is going to do on an ongoing recurring basis. So it's looking at things that either aren't going to continue, post-close. A lot of times in these owner-operator type businesses, the owner is taking out more salary than maybe is a fair value for what they're providing for the business. There might be a bunch of related party transactions. They might be running their annual trip to Hawaii through the business. There's all sorts of things that might be in there that might not be going on post-close. So you want to normalize all of those items into what this business is actually going to look like going forward. So that gives a little bit of a bird's eye view on valuation, but I do want to point out that valuation doesn't actually equal the purchase price. And so valuation is really just your starting place, and that gets you to A on this equation. So your multiple times your EBITDA is your enterprise value, but then there's purchase price adjustments that happen on due diligence to ultimately get to the purchase price you would pay for a business. Two of the items I'll touch on here are net debt. So if we go back to the idea of buying a house, if there's a mortgage on that house, if I own that house, I only get to keep the cash after I pay that mortgage back. Same idea on a transaction. You don't want to inherit all the debt and obligations that seller already has. Maybe you have a better relationship with the bank. Maybe you have a better credit rating and you could secure better interest in terms for that company going forward. You're going to pay them an amount and they have to take their net debt off. The other thing is capital expenditures. So if we continue on the home analogy, if you put an offer in on a house and you did the home inspection and you realized, oh, you know what, the air conditioning is not working, there's a crack in this wall, those types of things, you'd probably expect either the owner to fix that before you would buy the house or just to take the cost of those repairs off the transaction. Same idea with capital expenditures. Sometimes when companies are preparing for sale, they'll stop doing some of the maintenance on some of their equipment, some of those types of things, in order to put less repairs and maintenance on their P&L to make the EBITDA look higher. But that just might mean that you would have a piece of equipment that would break down on you pretty closely after close. So those are some of the things to be mindful of. Working capital tends to be one of the most contentious areas on deals. So I've dedicated a separate slide to speaking about working capital. Working capital, at the end of the day, if you think about what you're buying as a buyer, you're buying the future earnings and future cash flow of that business. And what you don't want to have happen is say, I bought a company that's doing $1 million in EBITDA, but to get that $1 million of EBITDA, I now have to put in an additional $250,000 to fund the day-to-day operations or the net working capital of the business. When you're buying a business, you're buying a group of assets that's going to generate that future earnings or that future free cash flow. So you're wanting to make sure that the assets are being left in place to generate that cash flow that you've paid on. And so really, when you think about working capital, think about it from the perspective of you want to make sure the batteries are included when you're buying that transaction, so buying that business. The one thing I will point out for net working capital, and this actually tends to be an area that causes one of the greatest litigation or disputes on transactions, is zero balances in net working capital. So with net working capital, you're set a definition of net working capital, which means these accounts are in net working capital, these accounts are out. And sometimes, even though an account by nature and what that account really means should be included in net working capital, but it was a zero at the time that you looked at setting that definition, sometimes people are like, it's zero, we don't need to worry about it. But what will happen is on close, there's actually a balance sitting in that account. And then that can be the cause of dispute where now you're going as a buyer, well, actually, I want that account in net working capital, and therefore I want to adjust the net working capital mechanism, say 100 grand. And the seller might say, well, it wasn't in the definition, so too bad. And so we actually see that go to court often. So make sure when you're setting your net working capital definition, you're doing it by what should be in there, not just whether there's a quantum in that account or not. So with that, we've kind of given you just a bare bones introduction into due diligence itself and the mechanics of the purchase price equation. But really, we wanted to open the floor and spend most of the time today having a chance to speak to you about your questions or how to approach the due diligence process. So would love to open the floor at this time, and thanks for joining us today.